Hi, everyone, and thank you for coming to today's presentation. Today, we will be looking at more closely at how companies scale in the digital asset industry. The basis for this presentation is a report that we recently published that analyzes the digital asset space, specifically the DeFi space, to cut through the hype and get to the insights that we all want. So let me first start with, who are we? Who am I? Blockchain Valley Ventures is a venture firm based across Switzerland and Singapore that specializes in fintech, digital assets, and emerging technologies. We have been in the market for approximately 4 years, and most of our investments have been across Europe and APAC. We're also part of the Draper Venture Network, the world's most active VC network, allowing us to have deal flow from all across the globe. True to our industry, most of our team is geographically dispersed, allowing us to better navigate the ever-changing areas of fintech, crypto, and digital assets. About me personally, I have a background in traditional finance, but was very quickly captivated by the opportunities and the rapid pace that new technologies offer. I'm currently based in Singapore, where I lead the Asian Ventures team, and very pleased to walk you through our presentation today. Let's start with the big picture. Where are we now? Right now, we are at the cusp of the fourth innovation wave in fintech, with applications across AI, IoT, and blockchain becoming mainstream and being part of our everyday lives. The first wave was the first financial software in the 1970s to the 1990s. The second wave was the online marketplaces of the early 2000s. And the third waves that we're all familiar with are the digital challengers, the neobanks like Revolut, Monzo, Chime, and so on. In this fourth wave, we don't only see enterprise software, but we also see alternative assets coming up, new asset classes, and really a fundamental shift to how data is treated. Keep in mind, please, that this definition of first, second, third, and fourth wave is relatively arbitrary, as many of these projects started a while ago, but only now they're starting to get mainstream adoption. As said, new technologies are reaching a level of maturity that was not here before. Today, specifically, I'll be focusing on digital asset perspective, as it has grown immensely over the past 5 years and has gathered a lot of public interest. As just mentioned, the last 10 years have really seen a surge in digital assets, led by price action and the Cambrian explosion of projects, companies, and everything around it. At the beginning, it was a niche asset where very few people invested in it, even fewer people fully understood. But by now, digital assets have established themselves as a new asset class for investors all across the world. The space has grown considerably in the last years, reaching and surpassing temporarily $2 trillion in market capitalization. That is a huge number for a nascent asset class. This really drives home that this new asset class has established themselves for investors across the world, and is something that even financial institutions are going into right now. One sector that has been especially interesting is decentralized finance, where a parallel financial ecosystem is being built, driven by new technologies, commercial innovations, and new business models. When we look at the digital asset space in general, DeFi is one of the most interesting areas in the space, but not the only one. Digital assets are found in enterprise, in supply chain, gaming, in NFTs. And while enterprise and supply chain are slower on the uptake because of the complexities of the systems that they live and breathe in, gaming and NFTs have seen a strong surge in the last 6 months, especially. Most of you have heard of NFTs due to the digital art auctions that Sotheby's and Christie's had, where digital art was sold for millions and millions of dollars. But there is a lot more to this technology than purely digital art. We believe that it will be the way how intellectual property will be monetized and will be stored in the future. Today, we're going to, however, focus on DeFi, as it is an area that has undergone a massive growth in the past 1.5 years, and it can teach us some valuable lessons about scaling in new markets. So let me first start with, what is DeFi? DeFi stands for decentralized finance and aims to build a new and better financial system by getting rid of intermediaries and using technology and economic incentives to bring financial freedom to everyone. One of the key metrics that is used to gauge whether DeFi is doing well or not is total value locked. Total value locked means and shows how much capital has been locked in DeFi applications. And that number alone in the last 6 months from January 1st, 2021 has grown 6-fold to over $109 billion. The areas that DeFi is active in are quite wide and include everything from lending and borrowing, so credit, to asset management, to derivatives, to decentralized exchanges and liquidity aggregators to provide liquidity on the assets that are being traded. However, there are also other aspects that will come up but have not yet hit mainstream next. Things like insurance, things like staking, and so on. So it's a very burgeoning space that has really exploded over the last year. When we talk about scaling in DeFi, our research found that projects in this space have 5 areas that they need to face when scaling. First of all is disruption, technology, regulations, incentives, and investors. When it comes to disruption, everything in DeFi currently is a hype. Even small projects seem very interesting, but have smaller markets, get a lot of interest from investors, both institutional and retail. It is, however, important not to be fooled by the hype and build products that are successful in the long term, even if that sometimes means to not jump on the latest hype train and let go of the latest dog-related coin. Technology is the second big piece. DeFi is inherently tied to technology, and that technology evolves at an incredibly rapid pace. This can cause challenges for teams as they need to be flexible and adapt to scale onto new platforms that gather adoption. The DeFi space is a place where projects follow users more than users follow projects. Therefore, teams need to be always flexible to integrate the newest protocols that make sense from a technological perspective, and really see where the market goes. A third area is regulations. This area has come up due to the success of DeFi. If DeFi had remained very small, no regulator would have bothered looking at it. However, now with over $100 billion locked in the space, regulators across the world are looking at it, and while they have not yet fully entered the picture, they are definitely on the sidelines. This has allowed teams to innovate freely without any of the burden of regulations, but has also caused a situation where most of the space is self-regulated and is heavily based on reputation. This will certainly change in the future with more regulations coming in, but for right now, it is a looming aspect at the horizon. Incentives. Offering short-term incentives to boost user activity and prices is a way to success. But it is important for projects to keep in mind long-term implications of using incentives, as they need to be carefully thought out to prevent disaster in the long run. Lastly, but not least, investors. As I just mentioned earlier, reputation in the space is everything, because there is no regulator that ensures the validity of the product. And if when and where people trust you with billions of dollars, having the right backers is incredibly important, and it can accelerate the growth of the space considerably. Now, when I talk about technological complexity, this is what I'm talking about. Ethereum, Polkadot, Cosmos, Binance Smart Chain, they're all protocols that offer similar functions, but have different mechanics. Projects that want to develop in this space need to be flexible enough to recognize when it's worth to add support for new tech platforms. And when I mean, just to show what I mean by fast moving, by the time that we did this research over the past few months, 2 of the now biggest ecosystems, Solana and Polygon, had not yet really showed up on our radar yet. And now it's completely different. Within a few months, this changed drastically, and they are now some of the most vibrant ecosystems out there. So this is when I say that projects need to keep into account how the technology develops, because they might need to change their protocol or include a new protocol within a very, very short time. When it comes to success in scaling in DeFi, we identified 4 factors that we think are key. First of all, the ability to have lean teams and be very capital efficient by leveraging existing technologies. You can think about it that use existing Lego blocks to build a house out of Lego bricks. You don't need to build every single block, but you can reuse some of the ones that you already have. This way, you can leverage existing technologies and existing smart contracts in a way that decreases team members and makes capital more efficient. Second of all, the ability to keep users on the platform and for them to trust you with their hard-earned money. This is essential because if you don't have users, the platform and the product you have will not scale going forward. The third point is the ability to create positive sentiment around the company and momentum on social media. This is incredibly important and oftentimes overlooked in a sector that is not regulated, therefore lives on reputation. If nobody knows you, if nobody trusts you, if nobody can feel like they can put their money with you because they have heard positive things about you, they probably will not, and you will not be able to reach a scale that you want. The last point is liquidity and trading volumes. This is important for long-term success, as one needs to be able to transact with projects. Otherwise, again, why should anybody put the money there if they can only put it in but not get it out? So in our research, these were 4 of the most important aspects that we looked at. Now, these are some examples of the quantitative analysis that we did that support our topic of lean teams and high capital efficiency. If you look at the numbers, teams are on average between 10 and 20 people, but control projects and companies that are often valued in the billions. That is a very stark contrast to the traditional startup world where you at least have teams of hundreds of people, usually for similar market capitalizations. At the same time, when we look at the financial aspect, the median project has raised around $10 million or less. This has been also concentrated into one larger funding round compared to the typical multiple funding rounds that traditional startups undergo. So if we look at the data, the teams are relatively small. They only raise a small amount of capital, but are able to leverage both aspects into large market capitalizations and successful projects. Now, you're definitely going to ask, okay, what does the future look like? From our side, we have a few predictions and outlooks on the future of digital assets. DeFi, first of all, will continue its unparalleled growth and as it challenges traditional financial systems in terms of yield returns. Then Ethereum will remain the dominant protocol for future developments, while still being challenged by many other protocols. Then Bitcoin will maintain its position as the stalwart of the industry, even as other crypto assets, just like Ethereum, will challenge its dominance. Then digital assets market in general will continue growing over the next years, even if not at the same tremendous pace that we've seen in the last 2 or 3 years. And then the last part is one interesting and underrated aspect will be the use of M&A in the digital asset space for companies to scale faster. We have seen initial transactions in this space, but we believe that the majority will still come, and it will be fundamentally different from traditional M&A in the traditional startup world. Now, when we come to areas to watch for future growth, there are 4 areas that we are really excited about. First of all is insurance. This is a big topic for institutional investors to come in. It has already some established projects like Nexus Mutual that are really pushing the boundaries of what is possible. But for real institutional money to come into the space, they will need assurances. So keep an eye out for this space and watch how it develops. The other part is NFTs, as I mentioned at the beginning. We believe NFTs will be the future of how IP is transacted, valued, and moved across the world. They have grown their fame through digital art and all the auctions that have happened in the past few months, but there is much more to it, and we don't believe that we haven't even seen the beginning of it. Next up is oracles. Highly automated systems, like in DeFi, need clear and reliable data sources. This is an area that we will see increased growth in because people want to make sure that these systems are resilient, are not prone to hacking, and that smart contracts that leverage these data inputs can really rely on them and they don't break apart. Then the last part is staking. In a future where the majority of digital assets is locked or will be locked into staking platforms, it is essential that new ways to deal with staking come up to ensure the economic viability of these systems. In short, we're very, very excited about the future of the space and think that we're just at the beginning of the journey in DeFi and are really looking forward to many other projects that will scale and reach the size of many previous ones. Thank you very much for your attention, and I'd love for you to reach out for future discussions as well as additional information on our research. Thank you very much.